Good morning, everyone, and welcome to KPMG's Q2 webinar on key reporting, regulatory and tax matters that are relevant to the asset management industry as we reach about the halfway point in 2025. So just to explain about the platform that we're using this morning, so you can customize your view on this to pull up and move some of the content around that you see on your screen. There's also an option to ask questions, so that feature is enabled. So if you have any questions, just pop them in the chat and we will get to them if we have some time towards the end. So what are we going to speak to you about today? So today's session really is designed to keep you informed on some of the key topical developments across financial reporting, regulation and tax, with a specific focus on asset management. And together with my colleagues, we'll take you through the agenda shown on your screen. And our goal is really to highlight the most relevant updates to you and to bring these developments to life with practical insights and examples where we can. So my name is Conor Maroney. I'm a director in KPMG's asset management practice, and I'll be starting off today's session with an overview of the current financial reporting trends and themes and upcoming changes that are relevant to the asset management reporters and some things that you should have on your radar. So the first thing we're going to look at, as I'm sure you're all aware, is around uncertainty on tariffs. Really, the uncertainty is multi-jurisdictional in terms of tariffs imposed by one jurisdiction on another cross-border, whether it be for the sale of services or goods. And right now, the only certainty is that there is uncertainty everywhere. The asset management industry doesn't escape this, and like all sectors, it is exposed to it. So from a financial reporting perspective, tariff uncertainty affects several areas across a fund or asset manager's reported financial performance. And let's just have a look at some of these areas that might require further attention. And this isn't a catch-all list. So the first area is around valuations. So all asset valuations are potentially impacted now or affected, both those assets measured at fair value, but also those that are measured at cost. So say, for example, a securitization vehicle or a private equity fund has a portfolio of assets that it measures at cost. Well, tariff uncertainty now can cloud the outlook for predicted future cash flows. And this then might increase the need for an impairment assessment, where in the past there mightn't have been a need for such. So that's assets at cost, and assets at fair value then also have increased uncertainty because there'd be greater reliance on potential unobservable inputs when trying to derive a fair value. And what that can essentially do is make valuations more complex and also potentially more volatile period to period. So valuations are an area of concern. And if they're an area of concern, well, then also performance-based accruals for funds or fund managers will also be affected, because uncertainty in being able to value your assets means there's challenges in determining whether a performance fee is calculable and whether it's highly probable for a particular period, which will allow you to recognize it in your financial statements under accounting standards. So those are two areas of impact that are interrelated to each other. And another is a little bit more broadly, which is around some going concern assessments. So in some cases, tariffs can raise issues like this for funds. So let's look at just some of the potential impacts to think about. The first is around reduced portfolio value and liquidity in the market for your asset class, and particularly for those funds that are exposed or affected to potential sectors or regions that have higher impact here. And this can strain financial stability for any fund or asset management company. Other areas of concern are around higher costs for underlying portfolio companies, and this can then depress earnings and returns. And what that does then is that persistent underperformance over a particular period of time can increase redemptions due to the uncertainty in the marketplace as people move their cash elsewhere. And that then ultimately reduces assets under management and can impair the fund's ability to meet its obligations to its investors. And so all of these things, either individually or together, can cast doubt on a fund's ability to continue as a going concern in the immediate future. So these things are all things that we need to think about now. In summary, the tariff uncertainty presents, I suppose, a broad range of considerations for asset managers that mightn't have been on the agenda for consideration over the past couple of months. So it's certainly an area, or years even, so it's certainly an area that requires refreshed and revised thought this year end. So the next area we're going to focus on is on some recent changes to IFRS, specifically on how a fund or a fund manager should account for electronic payments, which I assume is basically the majority of all payments into and out of funds or asset management companies these days. So at the moment, this is just impacting on IFRS financial statements, but it's expected that this update will permeate across all financial reporting frameworks over the course of the next couple of years. So it's something to pay attention to. So just to flag that this amendment specifically for IFRS is beginning for periods beginning on or after 1 January 2026. And so let's just refresh ourselves on a couple of key details before we jump into the topic. So the first is an electronic payment. Essentially these days includes any payment. So it's an online payment, it's a mobile bank transfer, it's a debit card or credit card payment or a virtual card or contactless. It's pretty much any payment we make today. And so before we jump into what the issue is and what the proposed fix for it is, let's just bring everyone up to speed and refresh ourselves on some of the key details on how a fund or an asset management company recognizes and de-recognizes either a financial asset or a financial liability. And it's pretty straightforward, right? So for financial assets, a fund recognizes this when it becomes party to a contract, and it de-recognizes it when the rights to the cash flow expire or are transferred to another party. And a financial liability is pretty much following the same principle. So a liability is recognized when the fund enters into a contractual obligation to another entity, and it's de-recognized when that obligation is either extinguished or otherwise qualifies for de-recognition. So far that's pretty straightforward. So really, what's the issue? Well, the issue really has developed over time, and it centers on timing. So specifically, when a fund should consider that a liability is extinguished after it makes an electronic payment. And what we've seen is divergence in practice emerge over the last couple of years, particularly as payment technology has evolved. So let's take, for example, Fund A. And Fund A treats its liabilities as settled on the day that it makes an electronic payment to a creditor. It de-recognizes the liability on that day. Meanwhile, you have another fund, Fund B, that waits until the payment actually settles through the bank with the counterparty. And sometimes that can take 1, 2, or even 3 days, depending on the jurisdiction that the fund operates within, or if it has to make a payment across borders. So what this creates really is a situation where two funds with identical creditors and identical payment terms and instructions made on the exact same day could report materially different balance sheets simply based on the economics or their interpretation of when a liability is deemed to be extinguished and therefore de-recognized from its balance sheet. So while the timing might seem pretty immaterial for a single transaction, it becomes a lot more significant in cases where you've got a leveraged hedge fund with multiple liabilities moving in and out every day. So in our example, if Fund B still shows a large liability at its year-end balance sheet date, and Fund A has de-recognized essentially an equivalent liability, the risk profile of each of those funds' balance sheet looks quite different, even though economically they're both in the same risk position. So what became clear is that practice had diverged on this area over time, and the accounting standards hadn't really caught up with the payment technology. So to address this, the IASB, the issuers of the IFRS financial statements, introduced an exemption. And that exemption essentially allows entities to now consider a liability as being extinguished at the point that they make an instant electronic payment, without having to wait for actual settlement of that payment a couple of days later. And this change brings clarity and consistency to an area that had long, I suppose, had confusion about how it was treated in financial reporting. So there are a couple of things that need to be met for a fund to de-recognize or extinguish a financial liability on the date that it makes the payment, rather than waiting for that cash to settle a couple of days later. And the three things that the fund needs to be able to do is to prove that, firstly, it has no practical ability to withdraw, stop, or cancel that payment once it's been made. The second thing is that the fund no longer has practical access to that cash that was used for the payment. So it can't use that cash in the meantime before it settles to go and buy something else or use it for some other purpose. And the third criteria that needs to be met is that the risk that the payment will fail to process or settle is pretty insignificant. So an example of that could be that the bank that the payment is being issued through fails within the 24 or 48 hours that it takes for the payment to settle, which in most market conditions is pretty unlikely. So if all those three criteria are satisfied, then the liability is considered to be extinguished as of the date that the payment is processed. So let's try and bring this to life by just looking at a quick example. So imagine that a fund initiates a payment on day 0, 2 days before its financial year end. but the payment doesn't actually clear until day 3, which falls into the next reporting period. The fund, in this case, applies settlement date accounting. So without the new IFRS 9 exemption, the liability would not be derecognized until day 3, i.e. the date that the payment actually settles. And as a result, on its balance sheet date, day 2, it would still report the liability on its balance sheet. With the new derecognition exemption, the fund can now assess those 3 criteria we spoke about as to whether then it qualifies to derecognize that liability from its balance sheet. So it determines that it has no practical ability to withdraw, stop, or cancel the payment, tick. It has no continued access to that cash, can't use it for anything else, tick. And it's very unlikely that there's a risk that the payment will fail to settle for a reason outside the control of the entity deemed to be met. The fund can derecognize the liability on the day that it makes the payment, and that's before its financial year end, because it considers the obligation to be extinguished from its perspective, even though settlement occurs through the banking system a couple of days later. So that's a key change this year from next year for IFRS reporters. And I suppose it's interesting to know that as time moves on, and you will have seen this with SEPA Instapayment in the EU over the last couple of months, and it continues to be rolled out, is that banks are getting quicker at issuing payments from one entity to another. So as technology within banks improves at sending cash to and from one another, this will become less of an issue. But for now, particularly cross-border transactions, it continues to be an open item and issue. So the next area we're going to look at from a financial reporting perspective is IFRS 18. This is just a reminder, I suppose, on a topic that we covered in a little bit more detail at our September webinar. And the detail, I won't go into it again today. If you want to delve into it in a little bit more detail, it is available for you in KPMG's Asset Management September webinar, and you can find that just by doing a quick Google search. So what I'll do today is just to remind you, I suppose, of what's coming and the key components of IFRS 18 without stepping into that additional layer of detail. So IFRS 18 is going to be introduced from 1 January 2027, but you're also required to give comparative 2026 disclosures. And so what that means is essentially issuers like an asset management company or a fund might need to decide fairly soon on, well, what are the types of metrics we want to disclose in 2027 with comparatives for 2026? And do we have the available data set up to be captured to allow us to make those disclosures from 1 January 2026 onwards, i.e. to capture that information? So let's provide a high-level disclosure, a high-level overview of what's coming down the line for IFRS 18. So IFRS 18 is essentially replacing IS1. IS1 was the standard in IFRS that kind of set out the basics of financial reporting. So that's an overhaul of that. And the new standard has 3 real key changes for IFRS reporters. The first is a more structured income statement. So income and expenses must now be classified into 3 main categories. Those are operating, investing, and financing income and expenses. And that aligns with the statement of cash flows then. And this change aims to really improve comparability across companies within the same sector, but ultimately across all issuers under IFRS. The second key change under IFRS 18 is the disclosure of audited management performance measures. And so management performance measures essentially are disclosures from an entity of the key metrics of performance in the year. And these must now be clearly defined. They must be consistently applied and disclosed year to year. And interestingly, they're also subject to audit where they weren't in the past. And this introduces a new layer of governance and scrutiny around, and I suppose control around the reporting of performance within a given year for the fund industry and other industries as a whole. And the third key change in IFRS 18 is greater disaggregation of financial information. So there's clear guidance now on what can and cannot be grouped together under vague headings like other, for example, other assets, other liabilities, other expenses, and so on. And this will help to drive more transparent and meaningful disclosure across funds, financial statements, and asset management reporters as a whole. So let's just have a look at a little bit more detail of the kind of key change, which is the management performance measures. So what is this? So management performance measures are essentially something that have been, are continue to be used in financial reporting at the moment, albeit they're, for want of a better term, unregulated, and they're known at the moment as alternative performance measures. In a fund, they're things like NAV per share or adjusted NAV per share. But more broadly, if you open the front cover of almost any listed company's annual report, you'll find a full page of adjusted performance metrics that the management of that company think helps to describe to users of the financial statements its performance in the year. And many of these measures do not comply with GAAP, and therefore, because of that, they've been on the agenda of regulators for scrutiny over many years, and IFRS 18 is an attempt to tidy all that up. So if we look at an example here, right, a company wants to present adjusted operating profit as a management performance measure. Under the requirements, this must be reconciled back to an actual IFRS financial statement metric, or essentially a subtotal that's an IFRS compliant subtotal, because adjusted operating profit is not that. And so what you'll see in the illustrative disclosure is that the non-IFRS management performance measure is reconciled back to the actual IFRS metric. And as well as that, what's required to be disclosed is a disclosure as to why the management of that fund or asset management company think that this MPM represents management's best view of the financial performance of the company, and also how it's calculated, and that should be calculated consistently year to year. So essentially, it's designed to improve transparency and help the users of financial statements. And so that's really the key change coming down the line under IFRS 18. The last of the updates then from a financial reporting perspective are upcoming changes on FRS 102. And this again was covered in more detail in our September webinar. So not to go back over old ground on that, again, it's available for you to search it and delve into the detail if you want. And these changes are upcoming from 1 January 2026. And there are some changes here that do impact on funds and asset management reporters. So let's take a quick look. So before we jump into that detail, it's important to note that the most significant changes brought about by this amendment is in relation to accounting for leases and revenue recognition. And this essentially brings FRS 102 more in line with IFRS, where in the past couple of years, IFRS 16 and IFRS 15 were introduced under that framework. But because funds have no leases and revenue recognition is pretty straightforward, so it's typically interest income or dividend income, we're not going to go through the detail here, but there are, I suppose, some considerations to make, right? The first is that the accounting disclosure for your accounting policies and the disclosures will need to be updated from 1 January 2026 for any revenue recognition notes. And also there might be fund management service companies that have leases for other entities within the wider asset manager group that also might need to be refreshed and revised in terms of how those are accounted for the asset manager group as a whole. So there are some considerations to make, but the key ones, I suppose, to bring you through from a fund accounting or asset management performance disclosure perspective are in relation to two things. The first is in relation to, I suppose, previously, if you wanted to account for financial instruments using FRS 102, you had three options. You could account for your financial instruments using IAS 39. You could also use IFRS 9, or you could also use FRS 102 standards themselves. So now there's a change that for first-time adopters of FRS 102, you only have two options. You can only use IFRS 9 to recognize and measure your financial assets and liabilities, or you can use the FRS 102 standards themselves. The option to use IAS 39 has fallen away. That's for first-time adopters only. So if you're an adopter that has used IAS 39 over the last couple of years, you can continue to use that going forward. It's just, I suppose, cutting it off for first-time adopters, and that brings it more in line with changes that have been made to IAS 39 for the exact same, for IFRS in terms of the removal of IAS 39 for the exact same reason. And the other key change, I suppose, from a financial reporting perspective in FRS 102 impacts on fair value, and specifically on disclosure of fair value for level 3 assets. So there's no real impact for funds that hold mostly level 1 and level 2. The key change is for those that hold level 3. And so there's improved disclosures and reconciliations required. And essentially, it's just imposing the IFRS 13 disclosure on unobservable inputs, on sensitivity analysis and reconciliations into FRS 102 to give those financial statements for funds or asset management companies a little bit more detail on harder to value instruments. So those are pretty much the key updates at this point in 2025 for financial reporters. I suppose bringing it all together, ESMA is the regulator and has, I suppose, in this space, and has issued some enforcement decisions on entities over the last 12 months on the topics that we discussed today. Firstly is those that poorly disclosed disclosures on key judgments and estimates were I suppose, targeted. Also, those that gave poor disclosure on risks linked to financial instruments were also targeted. And I suppose that area or that theme we expect will continue forward for 2025 reporting, particularly around the area of tariffs and the impact that those had, if material, on an entity's reported financial performance. So that theme isn't going to go away. And some of the old themes that continue to be there that IFRS 18 is due to, I suppose, resolve around performance measures, etc., they're also on the regulators' agendas and continue to be going forward. So that's pretty much it from a financial reporting update. It's important to assess the impact of these on your own business because they can be material and can take considerable amount of time to plan and implement. So what we'll do now is I'll pass you on to my colleague, Nicola, for the regulatory update.
Thanks, Conor. Morning, everyone. I'm Nicola Munley. I'm a director here in KPMG Law in our Financial Services Regulation team, and I'm just going to bring you through a quick regulatory update on what we can expect this year and coming down the tracks. So I'm going to start with the CBI Regulatory and Supervisory Outlook Report, which was published in February, which basically sets out the CBI's indications or what we can expect from the CBI over the next year, or what they're certainly looking for. As you can see there's an ongoing focus on governance, including outsourced activities. So that is something to be very mindful of. The AML, National Risk Assessment, also assessed the risks in the fund sector as medium high. And this is often driven by potential lack of transparency around ownership, or particularly if there's offshore accounts. Now we'll look further at some of the AML risks later on. One of the key risks, or one of the key roles for the sector, is in the European transition to sustainable economy. Now we'll see that the CBI noted in that report that there's been an uptick in Article 8 funds, but a downward trend in Article 9 funds with a potential for green hushing. So this is something obviously that they're quite mindful of at the moment. As always, there's cyber and data risks, and this is what the CBI have certainly highlighted cyber attacks and disruption as a potential risk, and that there needs to be a heightened vigilance and enhancement of barriers. And again, we'll look at some of that later. There's also been an engagement in relation to alternative assets, and we'll see that particularly around the crypto scene, where MICA is now in full flow. AI, which is the topic on everyone's tongue at the moment, it's still limited. The use of it is still limited, but there are benefits and risks, and we'll look slightly at that later. And data quality, again, issues that the central bank were finding was around the quality of data that had been reported to them, and this can often again be due to internal governance or data kind of practices or submissions. So that is something we look at. So that was the CBI outlook, some of the main topics that they looked at in the funds industry. If we go across, then obviously there's been much discussion on fitness and probity over the last couple of years. We had the ONRIA report last year in 2024 where the recommendations were made. Consultation paper was launched by the central bank this year, and that actually is closing on the 10th of July. So if anyone has anything they want to share with the CBI, that's open until the 10th of July. Some of the proposals there involved the CBI becoming more involved with assessments or assisting with assessments, including giving guidance to PCF holders on identifying objective measures. Also, the plan was to consolidate some of the guidance. As it stands, it can be quite bitty, so the hope was to kind of consolidate it and make it much more transparent and easy for people to access. And also a consolidation and simplification of some of the PCF roles. As I'm sure everyone's aware, at the moment there are quite a number of PCF roles and quite a number of sector-specific roles. So the plan or the recommendation was to remove some of the sector-specific ones, other than credit unions. So I should just flag that, and also give a more substantive review. So the consultation paper, as I say, is ongoing until the 10th of July to see if people have any difficulties with those recommendations. We don't foresee there being much of a pushback on that. They also have accepted some of the implementation of some of the recommendations and have taken on board the need for, we'll say, a specific fitness and probity unit within the CBI, which would hopefully streamline matters that people are seeing coming forward, and also clarity in relation to expectations, so that people are not wondering what exactly their roles and responsibilities are. So as I say, that consultation paper, CP 160, is closing on the 10th of July. So there's still some time if anybody would like to jump in. The next topic I'm going to fly through is our AML CFT package and updates. So there's a new package from the EU of AML CFT measures, which were formally adopted in May last year and generally to come into force from 10th of July into 2027, which seems quite far away, but as with all of these regulations, we find they come on top of us quite quickly. The idea is to harmonise the AML rules and provide us with a single rule book regulation, and that will hopefully extend the obligations to a broader range of entities. So mindful of the crypto sector again, so there is some sort of forward thinking there. We're also looking at the 6th AML directive, which will establish rules and procedures for FIUs, for intelligence units, to collect and share information across member states. And also we're looking at the AMLA, so the Anti-Money Laundering Authority regulation. So this the AMLA will be established to have direct and indirect powers to supervise in the financial sector and impose sanctions. So as always, we need to be mindful of where we see AML, there's always sanctions. This is some of the guidelines on the financial sanctions controls. It can seem quite muddy, but I've broken it down here to hopefully be a bit more transparent. So it'll apply from the 30th of December of this year. Plan is to have effective screening systems to reliably identify targets of restrictive measures and to also clearly define data that needs to be screened. There should be regular screening of your customer base with clear trigger events, and you should also assess the legal entity control or ownership. This is something that's very on topic at the moment. There should also be a calibration of settings of screening quality. You should also look at putting in policies and procedures to investigate any alerts and determine the trueness of a match, while also refraining from providing services to parties that you're not sure of before coming to an informed decision. So there should be a flow of your decision-making process there. You should also suspend execution of payment transactions and freeze funds or crypto assets. So this obviously is the stick that can be used. There also will be clear procedures for derogations and clear procedures to report to the competent authorities. So hopefully that'll make things more transparent for everyone. And we should also stay informed of trends to try and circumvent sanctions. Again, another date for your diary. There's, although not much time on this one, I'm afraid. There's a submission due on the 6th of June, so on Friday. So there was a consultation paper from the EBA on the 6th of March this year, outlining 4 draft RTSs, and that basically set out risk assessment, direct supervision, customer due diligence, and enforcement. So as I say, there's a submission on the 6th of June, and we can happily share the link there. It'll be on the EBA website as well. But the RTS, then the final RTS following those, any feedback should be due by 31st of October. We won't make any comment on the fact that it's Halloween, just in case they're worrying that it's going to be very horrific. FIDAR is coming into place. So this is Financial Data Access Regulation. So FIDAR has been on the minds of the European Commission since June 2023. So we're now 2 years into it. It's unlikely to be adopted before the end of this year, with it coming into full force sometime in 2027. Again, movable goalposts there. The aim is to provide mechanisms to allow customers, so data users and data holders, to share access to their financial data in a seamless and transparent manner. And it should also, the hope is to access a more expansive list of services. Now, as I say, it's still gone through the EU legislative process, so watch this space. But the idea of the data holder and the users, it'll include most regulated financial service providers, and that will include investment firms and insurance undertakings, mancos, and whatnot. Relevant data at the moment would be considered broader than some of the other legislation that we have currently in place. So it'll include financial products, mortgages, pensions, investments, deposit accounts. So it's something to be on the lookout for. This is kind of a breakdown of the overview of it. So the plan is, as I say, to put this mechanism in place so that customers can request a data holder to make their data available. The idea is obviously to make it more seamless so that we're not going from pillar to post. The customer must grant permission, and I'll just note that word permission for later, for the data to be accessible by the user. This permission can be withdrawn at any time, so that's also very important to note. The data user must only access the data stated for the purpose that it's given, and on the conditions it was given. And it must be made available to the customer as quickly as possible, in real time, and there cannot be a charge imposed on that. So if a customer seeks their data to be given to a fellow data holder or user, then there cannot be a cost put on that. There's a plan to put a new permissions dashboard in place, and this will allow customers to manage their permissions. So as I say, that's where they can withdraw their consent at any stage, or sorry, withdraw their permission. Again, sorry, note that word permission. It's also envisioned that a data sharing scheme will be put in place, so that will enhance the transparency and ensure the customer protection. You will have 18 months, so holders and users will have 18 months to join a data scheme. And so yes, you'll be required to enter into a data scheme, and 18 months to do that. Compliance with FIDAR should fall to the NCAs, so they will have broad powers to investigate any breaches, to start investigations, to launch enforcement, and whatnot, and then to sanction at the very end. As I say, obviously it hasn't come into scope yet. The NCA will expect it to be the CBI, but again, we'll watch this space. Some of the impact of FIDAR. So good and bad, as with anything. So the aim is obviously to improve the price and quality of financial services while protecting anti-competitive behaviour. So we're hoping to, discourage collusion in relation to fees or any sort of fixing in that scope. However, yes, so the risks, obviously collecting any sort of financial data or personal data carries a risk. This should be mitigated by the fact that there's a significant focus on consumer protection and ensure that it's only shared with customer permission. Now, in relation to permission, it's been noted that some of these definitions have not been they're not very clear. So the concept of permission is not very clear. It's not completely defined, and it's not aligned with the use of where we have consent in GDPR. So there's now, granted that the data is broader than in GDPR, but there might be a little bit of a pushback there. So financial institutions will need to review how they currently collect and manage financial data. So that's something to kind of be mindful of in the background, particularly around if there's any need for back office changes or data collection changes. So that is something that firms will certainly be facing in the next couple of years. But on the plus side, there are opportunities for financial institutions who can use data from these sources, hopefully to lead more data-driven offerings and to become more innovative. That's certainly the hope. But as always, we shall see. Bad news. Just in relation to an enforcement action, a recent enforcement action, just something to be mindful of. It's Cantor Fitzgerald Ireland Limited had a penalty imposed on them in February of this year of just over €450,000, and that was after the 30% settlement discount. They have, however, confirmed to the CBI that all failings were remediated by June 2023. This involved a breach of market abuse regulations over a 6-year period. So the Cantor was found to have been reckless in relation to submitting STRs to the CBI. Now, in the background, they had set up a STORA committee, which was not, they were not obliged to do so. So, however, the CBI found this was inconsistent with reporting, and it actually set a higher threshold than that required of what is required under MAR, which is reasonable suspicion. Also, records in relation to this committee were not kept. So it was unclear as to why decisions were made. So there was no paper trail really in relation to why some issues were escalated and some not. Also, just in a completely offside thing, some of the brokers were involved. There was a spot check done, just a compliance spot check, and some broker calls were reviewed. And they found that in a couple of occasions that suspicious kind of conversations were not raised internally. So yes, as I said, the CBI looked at this as always, and they saw that the failures were reporting suspicious transactions, having effective internal governance, which is always a big flag for the CBI. A failure to document exactly why some transactions were reported and some not, and a failure to escalate. And as I say, there was a penalty imposed in February. I'll leave you with some dates to note or things to look at coming down the track. Our old friend DORA has obviously been in place since January of this year, but again, be mindful of it with your ongoing obligations in relation to it. The AI Act will be phased in over the next 3 years, with deadlines in relation to AI models in August of this year, most of the rules coming in next August 26, and then rules in relation to high-risk systems in August 27. I think it's probably a good time to start looking at some of your use of AI if you're using it, and just be mindful of it in relation to the next couple of years. It's certainly the topic of note. I think it's the topic on everyone's tongue. INEDs need to be mindful that SEER will apply to them from the 1st of July of this year. So yes, this is something to be mindful of. Obviously, we're as I was talking about earlier, we're dealing with fitness and probity, but now SEER will apply to INEDs. Auto enrollment pensions has been postponed again. So at the moment, it looks like it's January of next year, but again, watch the space. And then in relation to sustainability, the Omnibus package was adopted in February 25, so February of this year, with an aim to simplify, possibly water down some of the sustainability regulations, such as CSDDD, CSRD, the EU taxonomy, again, be mindful of this, be mindful of your ESG obligations. And then there's also a stop the clock proposal for postponing CSRD reporting for 2 years. Again, watch this space. I'm probably just going to leave you with 3 takeaways, if I can, probably that you need to just be mindful of. So the first one is, as with always, be mindful of your internal governance. Need to have robust internal governance, particularly around obviously our AML and CFT obligations. Be mindful of individual accountability. It's a part of our lives now. So whether you're a PCF holder or an INED or whatever, just be mindful of that. And thirdly, as always, AI, data, anything technical, keep an eye out. It's here to stay. It's just a case of being mindful of what's coming down the regulatory tracks. So I'll leave it there, and I'll hand you across to my colleague Grace to give some of the tax updates. Thank you.
Thanks, Nicola. So hi everyone, my name is Grace Randalls and I'm an Associate Director on KPMG's FAC and CRS service offering. So I'm just going to kick off, right, because I know we're pressed for time. So the Irish Revenue Commissioners are currently very active in the AY space, right, and they've been selecting various reporting financial institutions, including funds, for FAC and CRS compliance reviews to assess their processes and reporting. So we had a meeting with Revenue in December at which we received an update in relation to their compliance review programme for 2024 and their plans for this year, right? So just to kind of hit on a few of the key points. So firstly, Revenue noted that they hit their targets for reviews completed last year and they'll continue to select Irish funds for review this year. So based on our discussion, a significant number of the reviews will be completed by the AY compliance team. However, some reviews will also be completed by local revenue teams. And they did mention that some funds will be targeted for compliance reviews. However, some funds will be selected at random. So for anyone that doesn't know, where a fund is selected for a compliance review, it will receive a letter from Revenue calling it for a profile interview, which will include an information request. And the information request must be answered ahead of the meeting. So if a fund is filing nil returns annually, there'll be about 20 questions included. However, if it files returns with reportable accounts, there can be over 75 questions included, which are really technical and detailed. So it's just important that, great attention is given to them and you take any of those reviews seriously. And Revenue did note that all compliance reviews to date have remained at level 1 and none have escalated to level 2. However, penalties have been levied on Irish funds that fail to comply with their obligations under the rules. So, and they're going to continue to do that this year. So it's important that FAC and CRS compliance is taken seriously. It's important to note as well that they're really in-depth reviews that Revenue are completing, right? So where a fund is selected for a compliance review, Revenue will typically ask for a copy of the policies and procedures and the full investor list. And they then review the full investor list and ask for support and documentation to be provided for a sample of investors. So that would include FAC and CRS self-certification forms and AML KYC documentation. So they've actually increased their sample size as well. So it's calculated based on a matrix. So for example, if a fund has a large number of investors, it could be asked to provide support and documentation for over 100 investors. So it's really important that funds have easy access to their investor onboarding documentation so that it's readily available to share with Revenue when requested. And they did re-emphasise as well that funds should be taking ownership of their FAC and CRS compliance and not solely relying on a third-party administrator, as ultimately the fund and the manager are responsible for the returns. So if Revenue are to levy penalties, they'll be levied on the fund as opposed to the fund administrator. So I'll just go to my next slide, right? Helpfully, Revenue summarised some of the key areas of focus, right? So these are key issues that they identified in 2024, which would be key areas of focus for 2025. So I won't go through them, but just data quality is kind of number one on their agenda, right? So it's really important that accurate and complete data is reported on annual FAC and CRS returns. Missing tax ID numbers will always be an area of focus. So they'll be looking at funds that are missing a lot of tax ID numbers for their reportable investors. Repeated late filers, so they don't want returns to be filed late, obviously. And I might use this as a reminder that 2024 FAC and CRS returns are due to be filed at Revenue ahead of the 30 June 2025 deadline. So this month, right? So make sure they're all timely filed. And then nil returns will be a key area of focus. So they want to make sure that Irish FIs are appropriately filing nil returns annually. and closed accounts. So they'll be looking at final FAC and CRS returns to make sure closed accounts have been appropriately reported, and undocumented accounts will always be an area of focus. So they don't want any funds to be reporting any undocumented accounts on their annual CRS returns. So on my last slide, right, just given where we are in the year, right, I think I'm just going to mention briefly that based on our discussions with Revenue, we understand that the OECD's 2023 updates to CRS, which is commonly referred to as CRS 2.0, will be included in the 2025 Finance Bill. So it's expected to become live in Ireland from 1 January 2026. And the first CRS 2.0 returns will be due to be filed with Revenue ahead of the 30 June 2027 deadline. So CRS 2.0 will bring e-money and certain crypto assets within scope of CRS. However, the OECD are also making updates to due diligence and expanding reporting requirements. So now is the time that funds need to be looking at their self-certification forms to make sure that the additional data fields are being captured. And fund administrators also need to make sure their systems are updated so they can pull the additional reportable data fields that I've listed into funds' CRS returns for reporting periods 2026 onwards. So I'll kind of leave it there, right? That's all from me, but I'm going to hand you over to my colleague Glenn Reynolds, who's going to give you an update on Irish VAT.
Thanks, Grace. Good morning, everyone.
Thanks.
My name is Glenn Reynolds. I'm a partner in our VAT practice. So today I'm going to very briefly touch on some topical issues in the VAT world impacting on asset finance. I'm going to look at the two pillars, maybe VAT exemption and VAT recovery first, then briefly summarize the topical developments. I'll move on to maybe highlighting some issues we maybe see in terms of the management of VAT, in particular in funds, and then very briefly I'll summarize what we're seeing in terms of Irish revenue activity. So as everyone would know, VAT exemption applies in Ireland to qualifying funds, and the majority of funds you will see in the asset management sector in Ireland are now qualifying. There was a change from 2023 to reclassify all EU funds, UCITS funds and AIFs as qualifying for Irish VAT purposes. What that did is it impacted the VAT recovery of managers and administrators, which I'll talk about in a minute. A slight change, which is probably not going to impact the majority of people on this call, is 1907 partnerships were added to the list of qualifying funds from 2025, and particularly where they have a qualifying AIFM. We get asked a lot, what does exemption apply to? It's relatively stable and well established in Ireland now. So it applies to the management of funds, which is your investment management, your marketing, your administration. A lot of the questions we get then are where else can it apply? And in particular, if you're looking at maybe outsourcing certain elements of the management, like either investment, advisory services, or other maybe core fund management services. And there generally is scope to apply exemption on other outsourced services, such as, for example, one or two investment advisors appointed to a fund. The big benefit of Ireland from an asset management sector is the ability for funds and fund managers to actually get recovery. So notwithstanding funds are typically dealing in shares and securities which are VAT exempt, an Irish fund can get recovery based on the non-EU profile of its investments. Typically, for example, you look at the NAV, and if 40% of the NAV is non-EU investments, you get 40% of the VAT back in the costs. There's also the ability for the Irish manager or the administrator to get recovery as well on the costs, which is quite beneficial. So effectively, you have an Irish manco and administrator, and you're managing a fund, which is 40% recovery. In turn, you can get your recovery. The look-through, this ability to take recovery applies to Irish funds. If you're managing an EU fund, it doesn't apply. So the management of an EU, for example, UCITS is exempt with no recovery for the manco or the administrator. Now that was a change brought about by the aforementioned January 2022 change, which actually impacted and brought down the recovery of managers and administrators in Ireland. So in terms of what's topical at the moment, outsourcing and the ability to apply exemption on certain outsourcing services, particularly in the investment advisor space, is quite topical at the moment. And the ability to get exemption on technology. So, for example, if you're going to outsource certain elements of your core management and you provide that via technology instead of people, there is potential to get that exemption on that. What it has to be is a core element of the management service, and not, for example, a basic maybe technology services which you might buy in from someone else that wouldn't qualify for exemption. Transfer pricing is quite hot at the moment. So, for example, if you have particularly more at the manco level or the administrator level, if you have a transfer pricing policy and you're bearing costs in Ireland, the VAT treatment of those transfer pricing adjustments is very topical. You can't assume that VAT exemption applies. Just because VAT exemption applies to the management of a fund, if you have transfer pricing charges coming in respect to the management of the ManCo, that doesn't always qualify for exemption, and that's something to be aware of. Otherwise, the use of data is quite interesting at the moment in terms of how we're seeing Irish Revenue audit and approach the management of taxes across the board, not just in the asset management sector, but it is one sector which is data heavy, particularly at a ManCo level, and we are seeing the increasing use of technology by Irish Revenue and an increasing use of e-audit techniques. So, for example, they will look for a year's data and they will analyse it, and they will then come back with questions for taxpayers. Moving on to the next slide, to maybe summarise the common issues we're seeing at a funds level from a VAT perspective. The first one is really a fund isn't not being VAT registered. Pretty much all funds in Ireland should be VAT registered, and if they're not registered, probably something wrong. As I mentioned before, funds don't make are typically not involved in vatable supplies, but there is an obligation to pay VAT on receiving foreign services from abroad, something like technology or advisory, Bloomberg. So if you have a fund, either administering yourself or someone else is doing it on your behalf, and it's not VAT registered, then usually there's something amiss there. The other common issue we see is the misapplication of VAT exemptions. So that's when people are buying in services, and for example, they think that exemption applies and they're not paying reverse charge VAT, but when you actually take a look at it, you go, well, it doesn't neatly fit within any of the exemptions, and that should be applied. So that's again a common issue we see, for example, when we take a look at funds or do audits or reviews of funds or ManCos. Linked to that is a weakness in the paperwork to support VAT exemption. As I said before, there is usually good scope to get VAT exemption in the fund world on outsourced services, but the paperwork needs to support it. And if you've light paperwork, it can just make it more challenging, for example, to agree a VAT exempt position with Irish Revenue. The other point we will see is deficiencies in paperwork supporting recovery. Again, funds will get VAT recovery on their costs if they've non-EU investments. If, for example, all the invoices are made out to the ManCo or to some other party and not to the fund, then it's difficult to get VAT recovery because the invoice must be made out to the fund itself. Other topical things we see are maybe the VAT recovery errors in the calculation. So every year a fund should revise its VAT recovery entitlement based on the NAV and the assets under management. If that's not done or if it's not correctly, it can lead to an exposure. I'll maybe finish off on a positive point there that it's not always bad news. Sometimes we see that funds are not claiming all the VAT recovery they're entitled to. So, for example, if you have a fund with a high degree of investment in non-EU assets, it should be able to recover a lot of VAT on its costs. And sometimes we see that the VAT recovery is not applied to the optimum position possible. And at a fund level, it's possible to either get recovery at the umbrella level or at the sub-fund level, depending on which is appropriate to the circumstances. Moving on, I'll very quickly touch on this slide, which is just a summary of the revenue interaction across the board. And what we're seeing is a lot of level 1 and level 2 interventions. We tend to see more level 1 interventions in the asset management sector, which is typically driven by maybe a claim made by a fund or revenue want to gather more information in terms of the profile or operationalization of taxes at fund level. And the big thing, and this is probably more relevant to ManCos and administrators, is really the tax control framework. The Irish tax authorities are moving on. They're not looking at the actual underlying symptoms. They're kind of going, what is causing tax issues? And having a documented tax control framework and documented VAT processes and systems and controls is very high in the list if, for example, there's a revenue audit. So that was really a high-level run-through of what's topical at the moment for funds and VAT. And I'm going to pass on to Ian Lockington, who's a partner in our investor reporting team.
Thanks, Glenn. As Glenn mentioned, my name is Ian Lockington and I lead the investor reporting team in KPMG in Ireland. Today, we just wanted to touch briefly on some of the key themes in investor reporting that would relate to distribution activity. Clearly, it's possible to view tax reporting as a dry subject, which is done 3 to 6 months after the year end, with no real direct relevance to your business. But what we're seeing is in a lot of conversations we're having with clients is that investor reporting is a key aspect of their business, which is required to support distribution activity. As you can see from the map on the slide, there's quite a lot of different European jurisdictions that have their own nuanced investor tax reporting regimes and other ones around the world. Now, we're not suggesting that you all become experts in each of the finer points of detail in each of those regimes, but we do see it adding real value where distribution teams or PMs who are working with clients have an awareness of these regimes so that they're able to give clients confidence and credibility when they're talking to them about, for example, launching new products or expanding into new jurisdictions. So if you're talking to somebody, for example, who is hoping to start to distribute product in the UK or Austria or Switzerland, it'd be important to also to be able to give them some advice on the fact that there are investor reporting regimes there. You might need to get an advanced registration, and that clients who are wanting to invest money in your funds may indeed choose not to invest money in your fund versus your competitors if you don't have the right set of investor reporting set up, maybe up front, and particularly if you're distributing through several sorts of retail platforms, you're just not going to get traction. So if you go through a lot of work, making sure that all your regulatory registrations are in place, that your prospectus updates are there, that your policies and procedures are right, that your investment management and investment strategies are really well targeted to your client, and you can understand and articulate those well. But it's also important, in our opinion, to be able to have in place the right registrations from a tax perspective so that you get traction with those investors. The one thing I would say is that this gives rise to a need for agile responsiveness, a deadline awareness in some of the regimes. And I think that being able to mention key points like the dates you need to register, the type of data that's needed, will help in distribution activity and in speaking to potential clients. Just want to move on briefly to talk about a couple of other areas where we see key risks arising from various tax matters. One, which is probably well known to you, but that we see boards starting to pay more attention to due to a range of factors. You know, boards want to demonstrate that they're having good oversight. They are aware of the fact that there's increased audit activity in these areas by various tax authorities, and they don't want to have unquantified exposures on their balance sheet. So areas that boards are focusing on at the minute are potential Spanish CGT exposures. You might think that you have no exposure to tax in Spain because you're an Irish fund and you do most of your work out of Ireland. But the Spanish tax authorities will tax gains on sale of listed shares in Spanish issuers. And mostly Irish funds will arrive in a position whereby they will get exempt from those gains due to the fact that they're either treaty exempt or due to domestic exemption in Spain. However, for each issuer that you hold, there's a requirement to file an annual nil return disclosing your exempt gains. And if that's not filed with the Spanish tax authorities, there's potential penalties of £200 or £100 per return. So if you held 80 different Spanish issuers across 3 or 4 different years, you could see how even with no taxable gains arising, you could end up with a fairly substantial penalty exposure if you didn't file your returns on time. Now, to date, we've seen less penalties been issued where there is spontaneous regularisation of the position. But with all tax authorities looking to attract more revenues, you could see how those penalties would start to be enforced. It's the same in Belgium with the Belgian net asset tax returns, which are due 31 January, which in relation to amounts outstanding in Belgium. Many people don't appreciate when they're setting up distribution in Belgium that there could be a real tax cost associated with those Belgian investors. And it's important, therefore, to price that into the size of the mandate that you're getting and to whether that gives that mandate viability in terms of the management fee that you're going to earn versus the actual costs then that are going to be incurred. And finally, we see a lot of people managing tax risks by ensuring that their marketing opening forms in various places are completed correctly, that they're not over or under claiming amounts of withholding tax, which can give rise to ongoing risks. One point in that area is that many of you will obviously have German status certificates to access reduced rates of German withholding taxes, and lead times on that used to be quite short. We're now seeing 4 to 5 month lead times for renewal and refreshment of those German status certificates. So that's something which is relevant to your business, then your status certificate is expiring soon. We'd recommend that those applications are filed as soon as possible. Obviously a very brief update, but now I'd like to hand back to Conor just to wrap up. Thank you.
Thanks very much, Ian, and thanks very much to all of you for joining us today. The content of this webinar, so a recording along with the slides, will be saved and stored online should you wish to revisit any of the topics covered in today's session. So all the presenters will be more than happy to engage with you individually on any questions that you might have that arise from today's session. You'll find our contact information in the materials. And so all that's left is to wish you all a good day, and thank you very much again for joining us today.